looking forward to more companies opening up in order to get back to business as quickly and as safely as possible. As we move closer to the point at which the stay-at-home order is lifted, now is the time to make some key preparations in order to thrive beyond COVID-19. In today's webcast, let me just advance the slide here. In today's webcast, our presenters will discuss how best to document your loan use for sake of future forgiveness, actionable cash flow management strategies, considerations for tax preparations, understanding the FTE calculations under PPP, what happens if someone quits during the PPP lifeline, and strategies for workforce maintenance beyond the 8-week period. The presenters will cover much more, and audience questions are encouraged. You can enter your questions on the question feature on your screen. We'll try to answer as many of those as possible, but based on the number of questions sent in before this webcast, there'll be no way we can get to all of them, but we'll do our best. Also, the slide deck and the calculations, the forgiveness calculations will be available after you fill out the survey upon conclusion. Before we begin, I'd like to thank you for your readership support and for your print and digital advertising support and event sponsorships, and for attending this webcast today. This is our 25th year as an independent, locally owned family business. However, to serve this community for 25 more years, we'll continue to need your marketing and advertising support now more than ever. I guarantee that we'll work hard every day to earn your business and to help you grow your business through our custom and integrated marketing programs. In addition, our award-winning editorial team is always looking for story ideas, especially forward-looking operational insights stories that can help our readers make more informed decisions in running their company, or insights on how to be better leaders themselves. I have 2 BizTimes announcements before we move to our presenters. As we all know, these last several weeks have been a challenge for many companies and their employees. Healthcare workers are at the top of the list, and many other employees have spent time working at home while also serving as educators and child care providers for their children. Our May 25th digital edition, which we're calling the Gratitude Issue, will be available at the same time the current stay-at-home order is lifted. We are providing you with an opportunity to run a full-page sponsored message along with your company logo on the cover. Use this opportunity to thank your employees for their hard work during this pandemic. You could also thank your customers and all the essential workers for their care and dedication. If you're interested, please contact our sales director, Linda Crawford. In the next day or two, please look for an invite to our next webcast, Economic Trends 2.0, which is next Thursday, May 21st from 10 to 11:30. The world has certainly changed in the last few months, so we asked our January Economic Trends presenters to gather again to provide us with their post-COVID-19 outlook. Dr. Mike Knetter will provide his macro perspectives, while Austin Ramirez from Husco, Jack Salzwedel from American Family Insurance, and John Kissinger from Grafe will provide their industry outlook. So now on to the presenters. When I introduce you, gentlemen, please give a quick shout out to everyone. The first person I'd like to introduce is Larry Glesman, commercial finance and corporate attorney with Davis & Kuelthau. Welcome, Larry.
Thank you. Hello.
And Tony Stefik, labor and employment attorney with Davis & Kuelthau.
Hi, Dan. Hi, everybody. Thanks for coming. Glad to be here.
Yeah, welcome. And then lastly is Ray Lampner, and a partner with Sikich. Ray.
Hello, thank you for having me.
So welcome, gentlemen. So we're going to get things started with Ray starting things off, and Larry as well, and then followed by Tony. So again, thank you all. And Ray, I'm going to turn it over to you and Larry with our first slide.
Great. All right, thanks. So we've been talking with clients quite a bit over the last couple months, kind of going through everything. And one of the things we ran into at the beginning, when the PPP loans came out, most of our conversations were centered around when our employees, as soon as we get this money, we're going to bring our employees back. We're going to look at just maximizing the loan forgiveness. And really wasn't much thought outside of things other than kind of that. And as the economy kind of has dragged on and things aren't recovering quite as quickly, I think, as people originally thought, conversations have changed to center more around cash flow planning and more of saving working capital within a business in order to continue past the 8-week period. And although everyone wants to maximize as much as they can the loan forgiveness, we're working with several clients that it's not necessarily spending every last dollar in order to get that loan forgiveness. So some of the things we're working on with clients is cash flow planning, and what happens over the next couple months, and how do you watch it and be prepared for everything going on. So we wanted to present a couple tools that could be used in order when you're going through this process. And so there's going to be 2 different tools that we kind of walk through, this being the first one, which is a 13-week cash flow. And 13 weeks is kind of an industry standard. It's 3 months. And you're really getting into the details of what's going to happen with your cash over that period. And so you'll see, across the top, we're scheduling out the weeks over 13 weeks, but we're looking at the cash coming in. So you have the sources. And so one thing to think about with this is the actual cash when it's coming in the door. So it's not a matter of going to your income statement and kind of, if you have so much in a month, you divide that by 4. This, you're looking at your accounts receivable and trying to determine when stuff is going to come in. And the same thing on the uses. When do you actually think the expenses are going to happen, and when do you actually have to pay for them? And so when you look down at the bottom, what you're getting to is kind of, this is what my ending cash is at the end of every week. So you're taking your sources minus your uses, and that's your generated cash. And then some of the things like paying debt, interest expense, and then kind of where does your cash end up? And you'll see what this will point out to you is if you look under the 6th column here, at the end, any cash at the end of June 15th is you're about $4,000 short. So the idea is that's letting you know we need to do some planning on, can we move some things around in order to get rid of that? Can we borrow against our line of credit to cover it? Those types of things. So really just, again, it's cash in, cash out over a 13-week period and kind of digging into the details. One thing to think about, and sometimes people tend to forget this type of stuff, is that we do have a line on there for tax distributions. A lot of companies did have good years in 2019, and then with the all the legislation going on, I think you'll remember they extended the due dates of the returns from 4/15 to July 15th, and also changed the first and second quarter estimates to be due at that time period. So on here, we're showing on July 13th that there's going to be a payment for taxes. So when you're looking at your taxes, make sure, or when you're looking at your cash flow, make sure you're taking that into consideration that although things may not be that rosy right now, that you still may end up owing some tax from last year. And so if you haven't really sat down with your accountant and gotten that number yet, that's something you should probably look into. Okay, I want to go to the next slide.
That's the next slide.
Oh, I'm still showing the, okay, no, I just changed. Okay, so this one's a little bit more, a little bit different, and it's over a longer period of time. Okay, that's okay. And so this is, and a lot of times when we ask people to do, financial projections, this is the income statement. This is what we'll see over 12 months. And the benefit of doing this is you can run different scenarios, and we'll do what we call like sensitivity analysis. What happens if sales drops 10%, 15%, 20%? And that shows you what it does to the bottom line. It starts giving you an idea if we do need to cut costs, this is what we need to cut, and what kind of position are we going to be in from a cash flow perspective. And again, this isn't cash flow, this is just from the income statement. And so this is going to be a traditional theory of when the expenses are hit, not necessarily when you pay the cash. But what we like to do is kind of some of the expenses like materials are going to be variable, and other things like insurance or rent, those things tend to be fixed. So we just like to set things up so that when you're adjusting your different revenue numbers, you can also impact it for those things, and some of those things will change and some of them won't. So it just gives you an idea of how to expect and how you're going to handle some of the lower sales. Go ahead and go to the next slide. Okay, this is a section When we do this, we always end up putting a balance sheet together with it, because although this might be helpful from an income standpoint, it doesn't really give you the idea of what's going to happen from a cash flow standpoint. And we go through this, and we'll put different assumptions in there. And so I know one of the concerns we're talking about with a lot of business owners right now is timing of collection of AR. And so maybe historically you've collected AR over 30 days or 45 or whatever it might be. So what happens to your cash flow if all of a sudden that goes from 45 to 60? And how does that impact it? So we'll kind of have everything go through here on a standard balance sheet. Cash, we just, whatever the standard number is that we feel that you need on hand just to run your business. What ends up happening is that the plug number that we use really is the line of credit. And so what I'll tell you is you're based upon all the other different factors from the income statement you inputted, plus maybe dragging out some of the receivables, is your line of credit going to be enough to cover you during some of these times? And so this will go out and look past the 13-week period that we were talking about before. And being this far into the year, you may want to think about, finishing out this year and then doing 2021 also. But you'll see it takes into consideration if you already have debt on the books, it takes into consideration paying that down. It'll take into consideration doing tax distributions and all that kind of stuff. So we're just recommending that if you're in a situation where cash flow is something you need to worry about, and I think that's going to happen for a lot of people, is that putting something together like one of these templates we kind of went through would be very helpful in planning ahead and kind of looking at things. So if you want to go ahead and jump into the next one and get into the PPP stuff. Okay. And so with the PPP, we've broken it up into what we're looking at as kind of like 5 different steps. The first step that we're going to talk about is the computational loan. And we're going to the assumption that everybody on the call has probably applied. And if they haven't received their money yet, they're very close to receiving the money. So we're not going to really get into the details of this. But I did kind of want to just kind of say, the wages and the wage computations that we talk about later still follow the same format that was used in the payroll costs on the original one. Some of the things we've been getting a lot of questions on, even post there, I just figured I'll go ahead and go through those. So, just so everybody understands. So one of the questions has to do with 1099s. So 1099s, if you pay those to people, are not included in your payroll cost number when you go through it. So subcontractors, salespeople that you pay in the form of 1099s, you do not include. Also, the payroll taxes. When I say payroll taxes, I'm referring to federal or FICA type taxes. There was a lot of preliminary language around adjusting your gross compensation because of that. You're not doing that anymore. That shouldn't be there. And then also self-employment earnings. So if you're getting a K-1 and you're paying self-employment tax on a K-1, or you're getting guaranteed payments or something like that, as an owner, you can also include all that stuff in this computation. Okay, I'm gonna jump to the next one. So the next one probably starts off where everybody, I'm assuming most people on this call are at, is trying to determine where am I at from a loan forgiveness standpoint, or how does it work, and what are all the different things. And one thing you'll probably hear on a common theme between the 3 of us today is waiting for further guidance. The SBA and the Department of Treasury are almost on a daily basis putting out guidance. So one thing we definitely say is that this stuff is as of today, but I'm sure it is going to change going forward. And just make sure before you go to do the loan forgiveness application with the bank that you do make sure you're up to date on what the most recent guidance is. So one of the questions we get a lot of is, when does the forgiveness period start? So it starts on the date you actually get a deposit in your account. So the date that you get the money is the date that the 8-week period starts. There's no room to change it. I've heard some conversations about using different dates and things like that, but the 8-week period is the date that you want to start. So what are the allowable expenses? And we've got a chart on the next slide to get to a little bit more detail. But some of the stuff we talked about, so we talked about wages. So the $100,000 limit is is still in play, and how it works out over the 8-week period is $15,385 per person. So once somebody reaches that limit, you can pay them more. It's just no more actually gets applied to to the loan forgiveness, and that's just on the gross wages. And I saw a chat pop up while I'm looking at this, but the question was, can we pay a bonus? And the answer to that is yes. Then we go through that, but you're still capped at that 15,385 number. And then again, that's on just the wages. So the next bullet is benefits and things like that. That's on top of the 15,385. So things like healthcare, retirement, state taxes imposed on employee payroll, those types of things are above and beyond the 15,385. Owner compensation is also in there. So this bullet is pretty much for people that are self-employed. And so before some of the guidance came out, I was getting a lot of questions, and actually had a couple from real estate agents. And the question was, I'm not selling anything right now, and so if I get a a loan based upon my 2019 profit, and I have no income right now, so does it all just turn into a loan? But what they ended up doing to compensate for that is that the compensation used on the Schedule C will be 8/52 of your 2019 profit. So you are going to get some benefit for that. Other things are included, rent, utilities, interest, as long as everything was in place before February 15th. Okay, so one thing to think of, so the 2.5 months that was used for the application is longer than the 8-week period. So what it really works out to be is if you kept everybody's pay the same, the 8-week period of payroll costs would be about 75% of what it was for the 2.5 months. So they have a rule in there that of the forgiveness piece, at least 75% of the costs must come from payroll. So that would be the first 3 bullets above. So at least 75% has to come from there. And then the other stuff that we're going to talk about in a second can't be more than 25% of the total. So if you have $100,000 worth of forgiveness, no more than $25,000 can come from the non-payroll costs. And then I think I've also seen this question come through, kind of pop up. Is it accrual versus cash? How do I figure out what actually gets in there? And this is definitely one of those spots that we're going to say that, there's further guidance we're still waiting for. So we're not 100% sure, but kind of what we're telling everybody is you want to use the cash basis for right now. So what was actually paid during the period? And if you're looking at things that maybe you don't normally pay during this period, you should be looking to see if you can accelerate into this period. So go to the next slide. Okay. And so the next one we're suggesting to people is to kind of project out over this 8-week period what you think your forgiveness is going to be. And this is going to, first of all, it's a good planning piece, so you kind of know what's going to turn into a loan versus what's forgiven. And number one, but also gives you an idea of, I don't know if the aggressive is the word, but how hard do you want to look for other things and how hard do you want to make things actually fall in this period? So we're suggesting you schedule it out with what your estimates are. So we kind of talked about gross payroll. Again, it's limited to the 15,385. Health benefits, so it's employer paid, health insurance, disability, dental, vision, all that kind of stuff. And then retirement's in there too. So retirement could be 401k match. If you're an ESOP company, the ESOP contribution could fall in there. And then also if you do profit sharing or you do a 401k match at the end of the year, you can include that stuff, but you need to get some of that paid within the 8-week period versus accruing for it. And so I've already seen where there's been some third-party administrators or for retirement plans that are actually taking contributions and basically they're just going to have a holding account until the end of the year or later on when you are able to allocate it to your employees. So that's something to consider. If that's something you normally do, again, you're probably looking for 8 weeks worth of expenses to pay during the 8-week period. State and local taxes paid by employer. The biggest example of that is going to be state unemployment. You have rent. Rent is not just your building rent. It is also going to be rent of equipment, those types of things in there. So as long as it's tangible property, I hear a lot of questions about, well, can you include payroll taxes and CAM charges and those types of things? I haven't seen any guidance that says you can, but a lot of people are asking about it, so hopefully it will be something in place later on, but who knows? And adjustment for above fair market value rent, unless it's out of line and it was in place February 15th already, and you're not making any changes, you're probably okay, but I don't know your lease terms, so we don't have those checked. Electricity, gas, water, transportation, I'll be honest with you, I'm not sure what they're included in there. They haven't really given much guidance on that at all. Telephone, and telephone's going to include if you're paying for cell phone bills for your employees. If you pay for those, I would include those. Internet, and then interest. So it's not just mortgage interest, it's interest on other applications. So if you have line of credit interest or anything like that, you can also take that as a deduction. And again, everything down from rent down can't be more than 25% of the total. Okay, Larry, I think I get to pass it on to you now.
Sure. Hi, everyone. This is Larry Glussman. We're moving on to the reduction in loan forgiveness piece here. They're basically, the goal obviously is 100% forgiveness of whatever you spend that is covered and therefore arguably forgivable. There are two tests that are out there that might reduce the forgiveness. One is the reduction of headcount or reduction in headcount. And on the next slide, you'll see there's a reference to a reduction in wages. So we've essentially put a pretty simple formula here for you to go through and calculate. It's based on the number of full-time equivalent employees that you had in the lower of either the February 15th to June 30th period in 2019 or the first 2 months of this year, 2020. Next slide, please. And as I said, the other test is a reduction in wages. There was a new rule, or excuse me, a new FAQ number 40 that came out a few days ago. I believe Tony's going to address that later in terms of what that means, but there's a question as to whether if you offer to rehire somebody and they decline that offer, whether you're going to be penalized for that. And again, there's an indication that there'll be further guidance on that, but the initial answer is no, as long as you follow a procedure that Tony will talk about. And then I know we've seen some questions in terms of, what if I can't spend all the money, or what if it's not all forgivable? So essentially, the advice we've been giving to folks is anything that you have that can't be spent on items that may be forgivable, at a minimum, you should just be prepared to give back either right away if you want to save the interest in terms of at the end of, say, after June 30th, after you've submitted for your forgiveness, or it can be kept for the remainder of the term of the loan, but you will be running the 1% interest on that for that period. But essentially, most folks should be able to qualify most of what they spend on the payroll side for forgiveness. And as Ray mentioned, or maybe alluded to, it may be difficult for folks to spend the full 25% I guess the maximum 25% that can be forgivable on the non-payroll side. But anything that you can't use in that category, you can shift over to the payroll side. Next slide, please. So this is the same spreadsheet that Ray pointed out before, but now it's got some new categories on the bottom for some reductions that go to the loan forgiveness piece and reductions from that forgiveness. So it's just the next iteration of the spreadsheet for you to take into account the calculations from the last two slides. Next slide, please. So there is a category denominated, well, here it's restoration of forgiveness. So essentially, well, actually, Ray, did you want to address this slide? I'm not sure really what
Go ahead. You're fine.
No problem. So, again, there's general guidance, and I know this is this theme we've been saying. We were supposed to get forgiveness guidance by April 26th. That date has come and gone. In this specific section, there was a reference to what they call de minimis exemptions from the requirements, and they say they may be forthcoming, and this is when the legislation issued, and there was no stated timetable. So this has to do with the issue of restoring wages and or FTEs by June 30th of this year. And again, one of the common questions that we get is, well, can I have folks back on June 30th, but can I turn around and fire them or otherwise? Do they have to be with us on July 1st? It seems a little disingenuous if that's the way things wind up being, but as things stand right now, there is no apparent obligation to keep folks on beyond June 30th. Next slide, thanks. So Ray's gonna maybe take the top of this one.
Yeah. So step 5, which is, hopefully the last step for everybody, is the actual application for forgiveness. And we're seeing this, we're envisioning this, no guidance is out on this either, but we're envisioning this to be similar to the application process where there's gonna be some questionnaires you have to fill out. But really the biggest thing is you're signing off that everything's true and accurate, and you're under good faith submitting the application. So you'll apply with your bank after your 8-week period is over, and they will have 60 days after the receipt of the application in order to make a determination. And this is the bank making a determination. And I envision it's gonna be a little bit different from bank to bank, but the application itself will be the same. So you're gonna have to get some information together, and depending on which periods you used would depend on which information you need to get together. So one that everybody's gonna have is an 8-week period, which is referred to as the cover period. So that's the 8-week period after you receive the funds. So when Larry's going through the documents down below, you make sure that you're referencing that. But the other ones will depend on which ones were used during your computations. Like he mentioned that you had 2 different base periods in order to determine your full-time equivalents, February 15th through June 30th, or January 1st, 2020 through February 29th. You probably only have one of those. So we just listed out all the possible different dates you might need, but you won't have to do it for every one of these, but just make sure whichever ones you use in the documents he's going to go over, make sure you accumulate documents for that time period.
Great, and just one quick point, again, for the periods covered, there was some additional guidance on an alternate measuring point for seasonal employers. So that's new within the last week or two. So if you are a seasonal employer, you have a little more flexibility to use any consecutive 12-week period in the May to September category period from last year. So then in terms of the documents that are needed, most folks are going to be using payroll tax filings that go to the IRS. Your payroll tax companies are able to provide that information, or at least I guess you can use payroll tax information from a payroll provider. We have listing here about state income and payroll and employment insurance filings, other sorts of documentation like cancel checks, et cetera. So the normal stuff that you would think would form the foundation to be able to prove up the expenses that were out there. Because again, as Ray mentioned, there'll be a certification that what you have is true and accurate, or true and correct, and will need to be substantiated. And again, we will at some point have a better procedure for this, so we can all look forward to that day. And I will just point out that there is a catch-all provision, and maybe this alludes to what's coming in terms of the further guidance, but there is this any other documentation that the administrator, and that's the SBA administrator and the Treasury, determines is necessary. So that's a pretty broad statement, but the stuff up above for sure is what you would think would be standard and customary to try to prove this up.
And can I just add real quick on that? The one thing about the payroll reports that are coming from the payroll companies, just be careful with those. A lot of the ones that we saw in the application process didn't end up being correct. And in their defense, they were dealing with guidance that was changing on a daily basis, and they were trying to rush through it to help people get ready for it. So they were doing the best they could. It just turned out some of it just didn't end up being right. So I would just be careful if you're going to rely on that. Just make sure you're looking at it to make sure it's being computed properly.
Thanks. That's a good point, Ray. So we're moving on to, you'll see there's a bit of a theme here, but in any event, I'm citing the wizard vid from May 1965, so 55-year-old prescient observation that the biblical golden rule is not what's being referenced here. It's some sort of financial golden rule. and whoever has the gold makes the rules. And so as we've seen, that's the Treasury Department mostly, and that's why for policy reasons and otherwise, things have been shifting so much, hopefully not overshifting as they appear to have with regard to the safe harbor and that sort of thing. So a little light humor, thank you. Speaking of changes, a week or 10 days ago, we were given an extension on the limited safe harbor until this Thursday, the 14th, to return those funds. Your folks who are turning their funds back are probably or strongly thinking about turning them back. May or may not be on this webinar. There's been, again, a little bit of shifting guidance on this and a lot of publicity about it. So the slide pretty much lays things out in terms of basically what you have to do in terms of evaluating this. And then if you make a decision to turn stuff back in, that'll be deemed to be a good faith certification. And sort of this is the no harm, no foul. But as I point out, that also means no money. And so we figure most folks that are on the webinar are, have made that decision or are going to have to finalize that and are probably at this point leaning towards keeping the money. So the bottom of the slide itemizes what you need to make sure your certification until we get a little further guidance about how that's going to be reviewed. And we were promised that before the 14th. So I keep checking probably about every 30 minutes to see if the Treasury's issued something. And there's nothing yet. So it remains to be seen whether they're going to extend that deadline again or just expect everyone to do this in a crash course over 24 to 36 hours. But without just flat out reading through the screen, this essentially breaks down the different elements of the certification. And we've been working with our clients to try to go through some checklists. I know Ray has one that he's going to make available afterwards, but go through some checklists so people can go back and look at their decision all over again from the start, and then add in this new standard of other sources of liquidity being available, and then essentially this test as to whether using those sources might be detrimental to the operation of the business, significantly detrimental, which would essentially excuse having to use them and permit using the PPP. Thank you. So now a couple slides on what I'm calling wildcards. We did learn within the last couple weeks that there will be audits of loans in excess of 2 million. Those will be conducted by the SBA, and they'll be conducted, I guess, from a period starting after the loan forgiveness application is reviewed by the bank and submitted to the SBA. How long after, who's going to conduct that, we don't know yet. And then there's a catch-all that says other loans as appropriate. So the $2 million limit, I guess the audit is supposed to be a certainty. We think it'll mostly be by computer in terms of trying to screen things out. But in any event, whatever other loans as appropriate means, hard to say. And then the sliding scale of forgiveness concept is something that is not part of the law. Hasn't necessarily moved further, but Senator Johnson from Wisconsin here did have an editorial in the Wall Street Journal a couple weeks back that he threw out that essentially drives some conversation among his colleagues that throws out a sliding scale that essentially has you comparing this year's revenue with last year's revenue. And if after the fact it turns out that you didn't do so badly compared to last year, then the thinking is that you shouldn't either, well, be entitled to or necessarily need the full forgiveness. And then there is an analogous provision for tax-exempt nonprofits as well. And then next slide, thanks. So a couple other things to think about. There's been some talk right now about whistleblower complaints or these KETEM lawsuits under the False Claims Act. So I just wanted folks to see what was involved in all of that. There's this question as to whether, I guess, folks that might bring these might have a genuine concern and interest in preventing abuses. They may be personally motivated, or perhaps have some sort of vendetta against their former employer or a company that they've dealt with. I guess it's another reference to the king here in terms of bringing actions on behalf of the king as well as for themselves. So it's a not often used mechanism, but there is some worry given the policy outcry over certain entities that arguably shouldn't have used funds, whether they're going to be subject to this sort of a process. And then finally, I just want to point out that on May 6th, there was a letter that our State Attorney General and 24 others sent to the leaders of Congress that essentially proposed an overhaul of the PPP program. I'm not sure when that would exactly take place. It wouldn't be retroactive, but it would presumably be for further rounds of funding if we head that direction. And I've tried to encapsulate, they listed about 11 different reasons and rationales for doing that. So I put them out here in terms of factors for you to think about. Again, just like Senator Johnson's proposal on sliding scale of forgiveness, this is not something that actually exists right now. It just exists on paper.
Tony, I think you're going to take over.
Yes, I am taking over. Thank you very much. And I realize we've gotten a lot of questions today, and that we want to keep some time for them. But I've got a couple of things that we want to talk about here. And it's usually after somebody talks to Larry and figures out that they have to do certain things with regard to their loan. And then we get a call and say, how can we do this? So 3 things I wanted to talk about today included calculating full-time employment equivalent employees, bringing workers back to work, and certain payroll processes. So the first slide talks about how to calculate FTEs. And my first point on this one is a common theme throughout my slides here today, is that we have no official guidance on this yet, of course. But at some point you have to make a decision as to what to do. So one of the things you can do is when you're calculating your FTEs, anybody who works 30 hours a week on average would be considered one full-time employee. And figuring out your part-time staff to figure out full-time equivalent employees, you would add the hours of part-time work in a month, and I apologize for the misprint here, it should say, and divide by 120, not by 20. And so if you divide that by 120, you'd get a full-time equivalent. When you're doing these calculations, remember that both staff and payroll levels must be maintained. Your staff numbers might still be high due to furloughed employees. And remember, furloughed employees are those who are still on your payroll. However, they've been basically put on forced unpaid leave due to slow work levels and so on and so forth. So you'd have to maintain the staff and the payroll levels. When you're doing this and ramping back up, like anything else, be sure to be cognizant of any discrimination concerns. There's always a potential for a claim based on who you bring back and why. A couple examples that are come off the top of my head would be, you don't bring back any employees over a certain age because you think they have some exposure or health concerns, perhaps. Well, that could turn into an age discrimination claim real fast. Another example could be you bring back people who did not take either paid sick leave or paid family leave under the FFCRA. Well, that could turn into a claim where you're discriminating against people for taking their federally guaranteed leave. Here, communication is key. You're doing all this work to make sure that you maintain your proper FTE levels. What you don't want to have happen is have a rogue manager all of a sudden get upset with his or her crew one day and decide to fire 5 people and walk them off the job. Well, they might be deserving of that. However, you've got other concerns to take care of here. So when you're talking about this, make sure you involve your key managers in your PPP discussions. Make sure that they are relaying certain concerns down to other levels of staff to make sure that nobody does anything that could throw a wrench into your gears. Next slide, please. All right, returning to work. We've got a couple of scenarios to talk about here, and we've been getting a lot of questions on these. And the 3 main scenarios are an employee refuses rehire. Scenario 2, employee returns but then quits. Scenario 3, employee returns but then must be terminated. What do we do? Are we stuck with these people, or are we stuck with these people's decisions? Now we have an answer, kind of, on only one of the 3. And in baseball, 333 batting average is an all-star level. When it comes to guidance from the federal government about how to comply with their laws, it is a really bad average. But it's the dartboard we're shooting at right now. So under scenario 1, if you bring an employee back and that employee refuses, one of the FAQs issued by the SBA says that you need to document that offer. You need to document the refusal by the employee to come back to work. Now, again, I apologize for the misprint. If the refusal is verbal, that is always tricky, right? Because you don't have any proof of it. Now, document it, but try your best to have more than one witness minding your offers and refusals. And if it involves having 2 people in the room when you make calls to bring people back to work, that might be what you need to do. On scenarios 2 and 3, we don't have any guidance yet. We're supposed to get some, and like Larry, I've been checking every day, and we're awaiting that interim rule. In the meantime, just document. There's nothing you can do. If an employee quits, there's nothing you can do. You can't force them against their will to work for you. That's bad. But at the same time, you have these concerns. So be sure to document it all. And I have to think that the interim rule that comes out is going to have some guidance, particularly on the employee must be terminated. I can't imagine a scenario where, let's say you've got an employee who decides to, commit a crime on the job or sexually harass somebody warranting termination. I can't believe that the government would insist that you maintain that employee's employment simply because of the PPP program. Along these lines too, we've been getting a lot of questions about, well, what if the role is the same, but a different person fills the role? We don't have any clear guidance on that yet, but the whole point of the PPP program was to protect your payroll. It wasn't necessarily to protect the pay of the specific employee. So again, you got to think that it just applies to your payroll. And if you've got role A and somebody's in role A, that as long as that role is filled, it would be fine. But again, stay tuned. We're waiting for guidance on that. All right, last slide, please. And then lastly, we get a lot of questions about what compensation counts under the payroll amounts. And a lot of questions, can I pay a bonus now instead of at the end of the year when I usually do? Yeah, you can. That's cash compensation as long as you mind that 100K limit. One of the questions that I've been getting a lot from my clients is, well, what if I do this? I give out these bonuses early and then the employee quits. Well, that's a risk that you run. Some folks have talked about requiring a payback of that amount if the employee voluntarily quits, but there is a whole slew of other employment laws and payroll laws that come into play there. And so the best advice at this point is just, that's the risk you run. Second question, can I require employees to use PTO and vacation during the forgiveness period? Yes, that's cash compensation. And except for federally or state law guaranteed leaves, that is a voluntary benefit that you provide. So you can put new or temporary rules into place during this period to insist on certain use of that PTO time. One warning on that, though, is that if an employee requests sick or family leave due to the FFCRA and you pay that leave, those amounts would not count for your payroll if you are seeking the tax credit on those amounts. So be sure to mind that. And also with regard to both of these scenarios, be sure to make clear to your employees that these are one-time things. You don't want to change your policy only to not change it back, and then you set new expectations from your employee. So that's real quick through those, but hope you found that helpful. And now we can turn to Dan and some questions.
Thank you, gentlemen. We were going to go till 3 o'clock, but we're going to see how questions go. We probably have enough questions for a couple hours more. So we'll go a little bit beyond 3 o'clock, and we'll do our best to get to as many of these questions as possible. And so let's just get to these right away. First question, Ray, are there other options outside PPP loans?
It helps if I unmute. Yeah, so there are some different things you could look at. So if you did not get the PPP loan, there is one of the options is the disaster loan. And not that I'm highly recommending it, but it's one of those things, I don't think it takes long to apply for it. And you can't go down that road. But we're seeing a lot of disappointed people that are getting money from it. That money is starting to flow, but it's not near the dollar amount people are expecting. So that is one option. The other option that's not out yet is called Main Street Lending. That's something coming out directly from the Department of Treasury. I'm not sure if that's going to go through the SBA also or not, but actually, you're going to go through your bank on this, is my understanding. So you are going to go through your bank on it. And they do have 3 different options in there. There's no forgiveness piece to it. The minimum loan size is $500,000. But hopefully, it's going to be another thing within the next week or two. We'll have some more details on it. But there are options as far as refinancing other debt or getting money, but it's based upon your performance in 2019 is what they're using as a base. But those are 2 other things that have been put out. And then, we periodically see, and like the U.S. Chamber came out with a $5,000 grant, those types of things. So we periodically see those types of things coming out. So just keep an eye out for, your local governments and things like that to see what kind of grants are coming out.
Great, thank you. Tony or the other fellows, if you know this, how exactly, it's regarding self-insured medical insurance plans, do they get forgiveness? Does it include all administrative costs of the plan as well as stop-loss premiums? Will it be checks actually cleared in the bank account starting after the date of PPP funds? That might have to do with cash and accrual, but in general, how are self-insured plans dealt with?
Okay. So I actually had this conversation with somebody a little bit earlier today, and the answer is it's an issue right now because what's happening is that nobody's going to the doctors right now unless they absolutely have to. So a lot of the medical claims are down, and so that's kind of what the problem is. That you're not having a normal in this 8-week period is going to be lower than normal. The administration question, I don't know if we have pure guidance on that yet, but we are seeing a lot of people that are planning on including that in the costs. And I would just say make sure you check it before you submit it to the bank for forgiveness. But really, it's like everything else we've been talking about. We're right now planning on it's a cash basis and what you're actually writing checks for during the 8-week period.
This one might be for Larry. With proposed audits of loans over $2 million, is there guidance on who will be auditing and who will be paying those audit costs? How much shaming do you believe the government will try to do for companies who make it through the pandemic period? How much pressure do you think there'll be on those kinds of companies?
Sure. Again, not to sound like a broken record, but we are without guidance on that as well.
Yeah, that's true.
The public shaming certainly has not stopped. The list of companies that have been called out and have subsequently returned monies continues to grow. I think the most egregious example was this hotelier. Maybe he's based in Texas, the one who owns a bunch of Ritz-Carltons, and I think in the aggregate they applied for about 172 or 178 million dollars worth of loans. I believe they've given at least 80 or 90 million of those back. So one would hope that the public shaming would have done 2 things. It would have gotten folks to give some money back, but it would have also created a bit of a deterrent for future participants, coupled with the new certification. Well, I guess it's part of the new certification. The audits are to get folks to really tighten up their analysis and think twice, think 3 times about the certification, whether they really want to stand by it. As I said before, we've been working very closely with our clients to try to memorialize the initial decision making and any supplemental basis for making the decision, so that folks are really ready when the audit comes. I've also joked that it might make more sense. I mean, I can't imagine how many auditors they're going to need to audit so many loans. I mean, I guess the ones over 2 million will be a shorter number. I do think that hiring contact tracers might be a more useful use of funds and ultimately more cost effective, but in any event.
True. I don't know who to answer this, but we receive PPP loan, assuming business will slow. At this time, business has not yet slowed, but I do expect it to slow later this summer and into the fall. Do I need to return the PPP?
So folks have essentially, I mean, you're not required to prove one way or the other that you needed the loan. Just provide a reasonable basis for taking the loan. So if things have turned out differently than perhaps you thought they might, that's where if Senator Johnson's sliding scale of forgiveness comes in, then maybe it'll turn out that it's not quite as forgivable as you thought. But still, getting money at 1% interest and having the ability to pay it back over 2 years is still a much better deal for folks than using their line of credit or cash that they might have in reserves.
When do all employees have to return to work in order to have PPP forgiven? Can you adjust the pay of employees during the 8 weeks? For example, I will be assigning a new manager and demoting the current manager, thus adjusting both of their pays. And I remember somebody saying that the number of FTEs and the wages have to both count there, but perhaps you could explain that again, one of you.
Yeah, I talked about that, Dan, and I think, again, we're waiting more guidance on this, and I know that's the answer that everybody doesn't necessarily want to hear today, but it is what it is. And under that scenario, you're bumping somebody up and increasing some responsibilities, but you're maybe demoting somebody else. Theoretically, under that equation, your payroll and your FTE count is still the same. So that would report the same on the sheet. So I don't see a problem with that. And again, one of the ways that I view this is, business has to go on, and you necessarily can't be held hostage by this law, and you need to make some decisions that you're going to have to make, as long as you're keeping all of this in mind.
Thanks. PPP, perhaps Ray, PPP forgiveness is if the state has not reopened your business, also can your PPP payments for payroll extend past the 8-week time frame? So maybe you can adjust that. If your employees are not back in work, do you hire them or have them do make work? And how is that affected by the 8-week period?
Yeah. So no, that's definitely a tough call at this point. So as of now, there's been nothing to say that the 8-week period is going to get extended. Now that being said, I think a lot of people are pushing for it, for that to get extended. It's just hard to say that that's going to happen and tell them to rely, as far as having that happen. So we do have a lot of people in the same place having issues with that. And so again, the worst case scenario is it turns into a loan at 1%, but hopefully in certain industries, or if you're still shut down, there will be a change coming forward. Just as of now, it has not happened.
Okay. Larry, maybe this one's for you. We're an S Corp who pays rent to a single member LLC owned by our majority shareholder. All of our real estate is in this LLC and mortgage free. We have a greater than $2 million loan, PPP loan. How deep do you think the audit will go? In other words, how vulnerable do you think they are if they're audited? Or he's thinking then they might be vulnerable if they're audited.
I was going to turn to Ray for some advice on that, and I saw that he immediately muted himself. So
no, I can take I can take it. Yeah, I'm more than happy to take it. Sorry about that. So one of the things you have to follow is it has to be in place before February 15th of 2020. So there can't be any change to lease terms. It also has to be at fair market value. Now, I think there's some gray area when you talk about what is fair market value of the rent. So as long as you're meeting those two requirements, you should be okay. We've gotten a lot of questions revolving around in situations like that. I didn't pay rent for a couple months. Can I put a couple extra months in this 8-week period? But just going back to, you need 8 weeks worth of expenses in the 8-week period. So I think as long as you're following those three things, we haven't seen the guidance, so I can't say you should be okay, but I would think that would be a good fact pattern for you.
Mm-hmm. This is questions related to workers' comp and an S corporation. So in an S corp, are health insurance premiums for shareholders a covered cost similar to a company-sponsored health, dental, vision plan? And another question is workman's compensation expense a covered cost? And are federal and or state employment expenses covered costs?
Okay, so a lot of questions in there. So with the health insurance of the owner, with S corps is typically grossed up in a wage at the end of the year. We have not seen any distinction of health insurance between the owners and the employees, and so our view would be yes, that should be included as in the health costs with everything else. The taxes that they mentioned, federal and state unemployment. So the tax line that we have on there, that's state and local taxes paid. So federal unemployment would not fit under there. State unemployment does. Workers' comp is a little bit trickier in that, and we don't have full guidance on this, but kind of what we've been discussing with people is that if you're actually, some of the states, you actually pay the state for workers' comp. So it's a tax versus insurance. And so they're willing to take the approach that would fit into that category. If you're paying the insurance company directly for your workers' comp insurance, I'm not sure it would fit in that category or not. And I'm not sure if there were any other. There were a lot of questions in that.
I know there were.
So, yeah, I'm not sure if I missed any.
They were fast and furious. I've seen this one before. How do you document payroll for, let's say somebody's an LLC and they're not a W-2 employee, or you have partners who are not W-2 employees. What kind of restrictions, and they maybe not be technically an employee of the company, are they included, and what limitations do they need to watch out for if they're claiming?
Yeah, so
not to be forgiven.
Okay, so the answer is it is included, and so if you're part of an LLC, there's two ways you can get compensated. One is through guaranteed payments, and the other one is through reporting self-employment income on your K-1. So those are two different ways that that's the income you would use for this 8-week period. It's subject to the $100,000 limitation.
This is another question back to the EIDL. If you also apply for the and the $10,000 advance from EIDL, is that deducted from your PPP loan forgiveness?
Okay, so the answer is yes. It's a little confusing. I don't know if people remember when you did the application. It was basically 2.5 times your payroll plus any proceeds you got from the EIDL. And so if you got the $10,000, what will actually happen is it increases your loan amount by the $10,000, but then also decreases the loan forgiveness. So in essence, it just turns it into a $10,000 loan is what ends up happening.
Got it. To apply for a PPP to be forgiven, does the company need to prove that it did not have access to other forms of credit? What if there is a line of credit at a higher rate to be forgiven? Does the company need to prove it didn't have significant reserves? So that's at that point. It's like, well, I'm applying for the PPP. I have a line of credit. Maybe it's tapped out. Maybe it's at zero. Am I in danger of taking advantage of the PPP funding?
So essentially, remember, this is all part of the Safe Harbor certification, or the certification process, and the test is whether using that money would be significantly detrimental to the business. So just having it available, we've had folks look at their line of credit histories. Is it something that they use every year? Do they use it seasonally? Do they not use it every year? Is it only every few years? If it's truly a rainy day type of thing, that would seem to militate in favor of it not being reasonable for them to be required to use it now. It's also a more expensive type of money, clearly, but that's not necessarily part of the test, although it would figure into whether it's more detrimental in terms of the higher interest costs. And one of the other things that folks are looking at is whether there are loan covenants that this might implicate in terms of whether spending on this gets them out of covenant on other lending relationships or loan facilities that they have.
Okay, thanks. I see this question, and I think I know the answer, but what about a monthly fee to our HRA benefits administrator? Is that part of wages?
I've seen people go both ways on this as far as the admin fees when it comes to that. There's been no guidance that says it is included, but again, there's no guidance that says it's not included either. So I would just continue to watch the guidance.
Okay. So the question, I sold a large percent of my business on March 25th, 2020, and those employees were retained by the buyer in determining my employee count and amount for the PPP loan. I only use the employees who continue to be employed by my company on the date of my application. I would think that he's fine, but that would be up to you guys.
Yeah, I think there's actually been guidance to come out to say that's how you're supposed to do it. So you just basically, you treat it as whatever you have now, what that looked like historically. So I think they're fine.
Our PPP loan amount was based off last year's payroll, which was higher than this year due to an employee leaving at the end of 2019. We understand headcount shouldn't decrease, but can it increase? Will the amount paid to the new employee be forgiven?
I think it's just total wages that you're paying in the original amount. So I don't think it really matters. If you replace somebody, you should be okay.
For trucking companies, do fleet lease payments qualify for loan forgiveness as mortgages for personal or real property?
So if it's truly a lease, the one thing I always tell people to be careful of, make sure is it a capital lease or an operating lease for your financial statement? So if it's truly an operating lease, as we're reading the guidance right now, that should be included as rent. But again, remember the rent in those types of expenses are capped at 25% of the total loan forgiveness.
Definitely. Okay. Can you fellas think of other hot questions that we haven't gotten to yet? We're after 3 and I don't want to take up too much more of people's times. I know that you'll all be available after to be contacted by anybody that has questions. When they're able to download the slide deck, your email addresses and your phone numbers are there. So, if you still have questions, I know these 3 are more than happy to stay connected with you and help you get through this. But any other hot questions that you can think of?
I just like to quickly point out that the SBA did provide, I believe on Sunday, a report on the second round of funding here. And so I believe it's from, I'll name it, late April through May 8th. They're showing that there still is capacity. There still are dollars available. So if there are folks that haven't applied, things have really slowed down to, I guess, what they're calling a trickle. But we're still talking about billions of dollars. I guess this probably goes to the shaming question earlier and the tightening up of the certification. Folks may just be less willing to get involved. There also is there are protections in there for smaller institutions, 50 billion down to 10 billion in asset value and 10 billion down. Each one of them has protected funds of 30 billion that are available. So a pathway to getting into the program, if folks haven't, or folks that are still looking, would be through using smaller institutions or CDFIs, credit unions, anyone that fits into that category, because the big banks may have less capacity than those folks do.
One thing I forgot to mention, though, I meant to earlier, is that probably about a week or so ago, the IRS came out and determined that the expenses associated with these loans would be non-deductible for tax purposes. And what that means is we've been told that these loans, the forgiveness piece would be non-taxable. So basically that just reverses that decision. Now, there's already some Congress people fighting to get that kind of overturned, and I'm confident it will be overturned, but as of right now, the expenses that you're using to pay from the PP loan are considered non-deductible. But again, hopefully that changes.
Oh, that's interesting. Just a couple more rapid fire questions. Ray, what is included in transportation costs?
It's a good question. I don't know. They have not given any kind of guidance whatsoever. We're seeing people include fuel expenses, those types of things. Some people think it might be more employee related with paying for parking, those types of things. But as of now, there's just been no guidance whatsoever on it.
Mm-hmm.
There's a little discussion of that in the self-employed section of the interim final rules. It may only apply to those entities, but they do talk a little bit about transportation costs in there.
And then going back to our first few slides, should I be talking to my bank if I'm expecting significant cash flow issues? What's the best way to have a relationship with your banker?
So my experience is if you're having issues, you should be talking to your bank 100% with that. But I think you need to go to your bank with a plan. So just going to your bank and saying I'm having cash flow issues and not having a plan or anything like that, I think is could be harmful to the relationship. So what I would do is spend some time on those schedules, get an idea, see where you're at, see what the bank can do to help you. But again, have a plan to kind of get things turned around, whether that's cost cutting or whether that's having additional revenue streams coming in later on. But just, like I said, I think it's great to have conversations with your bank, and you should. It's just make sure you have a plan when you go in there.
Larry, what types of things do you think could be safely prepaid? Could rent be prepaid or a portion of it, especially if your funding was received mid-month and your rent is due the first of the month? Technically, you could make 3 rent payments if your first payment was late.
I guess it depends on how lucky you're feeling.
The ruling has not been settled.
Yeah,
I would imagine it's prorated based on that 8-week period. That would be probably my guess. Okay, does anybody else have anything that you see on the questions that are submitted before we go?
Yeah, real.
Oh, go ahead, Tony.
I was just going to say real quick, Dan, at the end, I've seen a lot of questions come across about what about folks who are working with you through temp staffing agencies?
Oh, right.
There is, in the Q&A on this, it makes pretty clear that that a temp employee is not employed by you. That temp employee is employed by the temp agency. So that the amount you pay for the temp would not be under your payroll expenses.
And I'm sure those temp agencies have their own challenges in trying to figure this whole thing out.
That is exactly correct.
And they can probably contact you all because you're the experts. So with that, we're going to conclude. I'd like to thank Larry Glusman, Tony Stefik from Davison Kuelthau, and Ray Lampner with Sikich. As I said, I know these fellows are available to address the many questions that we have. They're the experts. Their contact information is on the slide deck, which you will be able to download, as well as the in the sponsor message area. There's the loan calculator, the forgivable loan calculator. Ray was able to provide that for us, so thanks, Ray. So fill out your survey, and you'll get access to all that information. Again, we'll try to get they'll try to get some of those questions, get the survey done, and as a reminder, our Economic Trends 2.0 is next Thursday, May 21st, from 10 to 11:30. And again, thanks everybody for taking time out of your day. We know that cash is king. Talk to your bankers, come with a plan. And it's an important time now to plan for your post-COVID-19 thriving strategy. So with that, have a great day, everybody. And we'll talk to you later. Take care.